name is Ibrahim Rashidi, class 412, Dr. Chatterjee. I've submitted the Word and the PowerPoint and Excel. This case will examine the aftermath of not preparing a cash budget in time and how the victim company can resolve issues of an elusive cash balance by preparing a perfect cash budget in time. Also, the case will address some of the factors that led to the elusive cash balance situation, as well as prepare a cash budget that can save the company from the risk of being denied credit by its suppliers, as well as financial loans from creditors. Before we get to answering some of the questions raised in this case, it's important that we familiarize with the main financial concept of this case. A cash budget is basically a detailed company budget that indicates the company cash inflow and outflow during a specific budget period, such as month, quarter, year, or annually. The primary purpose of a cash budget is to determine the cash position of the company at any moment. In this case, we are going to use the monthly cash budget because the company needs to purchase payment in the budget period, as well as help the company to analyzing budget versus actual variances in cash flow, inflow and outflow within 30 days. In this case, the financial concept that plays a big role in the cash budget. A cash budget is a detailed budget of expected cash receipts and disbursements during the period. Cash flows in the cash budget include revenues collected, expenses paid, loans received, and payment. In other words, a cash budget itemizes the project source and uses of cash collected in a future period. Cash budget determines whether the company operation and other cash earning activities will earn a sufficient amount of cash to meet projected cash requirements. Without a properly prepared cash budget, the company management team must find additional funding sources to keep the company running. Otherwise, the company will have to no other option concept to shut down its operations. Additionally, a monthly cash budget will help the company to solve cash requirements on a monthly basis. Also, it will help the chief accountant to forecast the payment that need immediate fund allocation and identify sources that can raise funds to offset cash requirements. A monthly cash budget will assist the company determine short-time investment that can earn the company profits while the fund is not used. For instance, if the excess funds are available for a couple of days, it may be invested in fast-moving investments or short-term deposits, which can earn interim income for future cash requirements. Benefits of a monthly cash budget include provision of a clear picture of all expected cash flow for the current month and the entire year, optimizing the utilization of funds in case of cash surplus, helps the management to estimate the income that business will receive during the coming month, as well as how much it will pay in expenses. Give a clear picture of the cash balance each month and for as much as 12 months ahead, thus giving the management the assurance that the business can make important payments, especially if the business has an overdraft and wishes to ensure that the limit placed on the loan by the bank is not exceeded. Helps in identifying excess payment over receipts well in advance so that appropriate action can be taken to provide for a shortfall of cash. Now that we are familiar with what is a cash budget plus its benefits, it's important to understand how to prepare a cash budget. A cash budget is prepared using the company financial history. Here the chief accountant has two basic approaches from which to choose. First, the chief accountant can use bank statement to gather prior year receipt and disbursements history. As such, the accounting can start with monthly figures, subtract the total monthly disbursements from the total monthly receipt to determine the net change in cash flow, and then add the beginning cash balance, determine available cash surplus. With 3-year information, the chief accountant can identify that one-time receipt or disbursements that will have to be considered in projecting for future years. As much as the approach is simple in preparing a cash budget, it lacks detailed receipts and disbursements that make it possible to analyze why cash flow may vary month to month and year to year. Another approach is the 3 to 5 year historical database of cash received by the source of revenue and disbursements by category of expenditure. It's a more complex approach, but more accurate and therefore very useful. After selecting the suitable approach based on the situation, the next step is projecting revenues. Projecting revenues flow can be done in the following steps. 1. First, prepare a 3-year history of concept showing the presence of each source of revenue collected per month. Second, project monthly amount by multiplying the monthly percentage by amount budgeted for each source of revenue in the new fiscal year. Third, adjust the cash budget revenue projections by known events that will occur in the new fiscal years. After being done with projecting revenue flow, the next step is projecting expenditures. Projecting expenditures involves forecasting expenditures on the same basic as monthly, weekly, or daily revenue, depending upon the availability of the information from prior years and need for detailed projections. After doing all the three steps, the accountant can go ahead and develop cash budget for a company. Now that we are familiar with the cash budget definition and how to develop one, we can work on case 21 questions. The major problem affecting this company is failing to prepare a set of short-term balance sheet, would allow the company to aware of the extent of negative cash balance and the resources available to leverage. As such, the company should produce a profit and loss statement, which will help the company to be aware of whether it's suffering from lack income or lack of cash. As stated above, an analysis of hand distributing cash flow statement and its key ratios will help Patrick to realize that the buildup of inventory and receivables without a proportion increase in external financing is the reason as to why the cash balance has dropped so much over the past few years. In this situation, the inventory doesn't match with turns, as it doesn't move at constant rates. As such, the contract between the company and suppliers doesn't incent the suppliers to sell the best moving item and work with the company to improve inventory productivity. Patrick should determine the company accounting cash flow from operation because it can be used to calculate other parameters that give information on the company cash position. Also, Patrick will use accounting cash flow to determine problems with the company liquidity, inventory rate of return, and the timelines of cash flow into and out of the company projects. As you can see, the company cash flow has decreasing from 2015 to 2017, meaning that the company is not doing well. In 2015 was 752,601. In 2016 is 448,647, and 2017 is 360,000. This shows that the cash from operation is reducing annually, which is a bad thing for this firm. This shows that the company is not earning from the operation. Patrick should prepare a monthly cash budget for hand distributing because it would provide the increased information to the distributor would need for good planning. Also, all debts are paid in 90 days, giving the distributor enough time to settle debt without the planning its liquid cash. Further, the distributor plans to purchase a delivery truck in May of the coming year, which falls between the second quarter of the year. As such, a monthly cash budget would be appropriate. Except for March, the company can pay for other expenses other than purchases. Also, with this cash budget, the cash balance is expected to increase as operation costs increase as well as inventories. Additionally, although that loan balance is increasing. Except for March, the company can pay for other expenses other than purchase also. With this cash budget, the cash balance is expected to increase as operation costs increase as well as investors. Additionally, although the loan balance is increasing, it's because of the additional loan invested in the new inventory and the purchase of a new truck. However, the amount borrows and repaid vary each month according to the cash balance available for investment. The months that are most vulnerable to cash deficit in January and March. The month with the greatest surplus funds are October, February, April, May, June, July, August, September, November, and December. Fund distributing needs to implement better policies for managing its operating capital, especially its inventory level and its account receivable. The level of these two have increased significantly over the last few years. Much needed cash could be saved by reducing these current assets. Thank you for listening.